Kirtan Shah, the founder and chief executive officer of Credence Wealth Advisors. Thank you so much for taking the time. Kirtan, they've become quite infamous of late, these Greek alphabets. The Delta variant, for example, of the COVID-19 pandemic caused quite a lot of issues across the world. But here we're talking about alpha and beta. Let's start with alpha. I guess the best way to understand it is to look at what it isn't, right? So can you help us with that?
Alex, thank you so much for having me on the show. Alex, unfortunately, alpha is a very loosely used term in the Indian financial markets context. It's just not the newbies who don't understand finance, but also a lot of people like us who are already a part of the industry also very loosely use the term alpha. Alpha predominantly, as per industry context, is generally denoted or used for representing excess return over index. What that means is that, let's say, if the Nifty generated 12% return, but if your mutual fund has generated 15% return, you've typically generated a 3% excess return over the benchmark, which the industry calls as alpha. Now, please understand that's a very loosely used term, and that is not what alpha is. So alpha is not excess return over the benchmark. Actually, technically, when you generate excess return over the benchmark, that is termed as something called as active returns. So the 3% returns that you've generated higher than the benchmark is actually called active returns and not alpha. Alpha actually means the excess return that you've been able to generate over the minimum return that you would have had to generate as a scheme, right? So let's say if there are two schemes, scheme A and scheme B, right? It is not necessary that both the schemes take the same kind of risk. It is not necessary that for both the schemes, given the risk that they are taking, they ideally have to beat the benchmark. But typically, because as an industry, the way we put things in context, for us, beating the benchmark is more relevant. And hence, for all of us, while we discuss alpha, we consider the minimum return that the scheme has to generate is the benchmark, but that's actually not the case. So what I'm trying to tell you is that the excess return that you generate over the benchmark is actually termed as active returns, and alpha is a separate context. Alpha typically means that the scheme, given the risk that it has, would have a minimum return expectation aligned to it. And only if you are able to beat that minimum return, right, then over and above that minimum return, what you generate is called the alpha.
Okay. I think to understand this in better detail or in more clarity, one would have to understand how this minimum expected return of a fund is calculated. This would obviously be forward looking, right? Because you're expecting a certain amount of return. How does one calculate this?
So Alex, that's exactly where this concept of beta comes into picture. So beta is technically called the market risk, right? And because it's a comparative analysis, it's always assumed that the index risk or the index beta is denoted as 1. So let's say if the index beta or index risk is 1, and your fund also has a beta of 1, and that comes through some calculation. So let's say the index beta is 1, your fund's beta is 1, which means both of you are taking the same kind of risk, and hence both of you all are expecting the same kind of return. But let's say if the index beta is 1 and your fund's beta is 2, which means you're taking higher risk than the index, and hence the minimum return expectation from your fund is going to be higher than that of the index. But at the same time, let's say index beta is 1 or risk is 1, and your fund's risk is 0.5, which is lower than the index, then you can't expect this fund to generate minimum returns to be the index returns, right? Because you are taking half the risk of that of the index, your return expectation or minimum expectation of returns from you is going to be much lower than that of the index. So while we are trying to calculate minimum returns, the focus is how much risk that the fund is taking. If the fund is taking equivalent risk to the index, your return expectation is equivalent to the index. But if your fund is taking higher risk to beta than that of the index, your expectation from that fund is much higher than the index. So the higher return is your minimum expectation. But if your beta is 0.5, which is lower than that of the index, the return expectation from the fund is not the index, but lower than the index. This is how you define the minimum expected return, depending on the risk that your fund is taking, Alex.
Okay, help me understand beta a little bit more. By my understanding, it relates to how much, and if we're talking about, say, a component or a constituent of the Nifty 50, for example, as the benchmark index, you would look at an HUL and you would say that the beta of HUL is lower than certain other stocks. Is it the movement of HUL vis-a-vis the movement of the index? If it is not as sharp as the index, then it has low beta. Is that how you understand it?
Absolutely. So if HUL's beta is 0.5 and Nifty's beta is 1, then what we are technically saying is that HUL is slightly less volatile than Nifty, and hence your return expectation from HUL technically should be lower than that of Nifty, because HUL does not have that kind of risk that Nifty has. But at the same time, if you take an infra stock or a real estate stock, which might have a beta of 1.5 or 2, which is higher than that of the index, then typically you are saying that while I invest in that particular stock, I'm taking risk higher than that of the index, and hence my return expectation from that particular stock should be higher than that of the Nifty. So depending on the risk that you are taking by investing in that particular stock or fund, right, you decide on how much return are you expecting. Your return expectation should be higher if your beta is higher than 1, and your return expectation should be lower if your risk is lower than that of the index. But it's slightly different, Alex, when it comes to a mutual fund, right? So let's say, for example, if I'm trying to invest in a mutual fund, so as a retail investor, I would say that, look, today fixed deposit is giving me 5% returns. So while I invest in a mutual fund, I should at least get 5, right? But if I'm investing in a mutual fund which is investing in the stock market, I don't want fixed deposit kind of returns, right? So if I'm investing in a mutual fund, you should at least give me 5%, which the fixed deposit gives me, and give me at least 7% more because I'm taking investment or risk by investing in the market. So we are saying, while I invest as a mutual fund investor in the stock market through mutual funds, give me 5% minimum because that's what fixed deposit gives me. Give me 7% more as risk that I'm taking. Right now, this 7% is for the risk that I'm taking. Now, let's say if the fund has a beta of 1, I will expect my fund to give me 5 plus 7, right? Risk-free 5, 7 for the risk that I'm taking. But let's say if my fund is taking 2 beta risk, then I will expect 5 for the fixed deposit, plus I will expect 14, 7 into 2, 14% return from my fund as minimum, right? Because it is taking twice the risk of that of the index. So 5 plus 14, the minimum return expectation from my fund then becomes 19. One more example to clarify this. Let's say if my fund takes 0.5% of 0.5 beta risk, then the return expectation from my fund is 5 for the fixed deposit, plus only half of 7 into 0.5. So I'm expecting only 3.5 for the risk. So now my expectation from the fund is 5 plus 3.5, which is 8.5. That's how you decide the minimum expectation from the fund, depending on the beta risk that the fund is taking, Alex.
Okay, so you explained how minimum expected return is calculated. Can we extrapolate that and now understand how to understand alpha based on the examples that you just gave us?
Absolutely. So let's say, for example, the index generated 12% return, and the beta of my fund was 1, same as index. And if my fund also generated 12% return, that was the expectation from the fund, and hence the alpha that my fund could generate was 0, right? But let's say there is another fund which has beta of 2. And I just explained to you, when you have beta of 2, the minimum expectation is 19%. But let's say the fund generated 12% return. Now you would think that the index generated 12, fund also generated 12, so your alpha is 0. But over here, your alpha is -7. Why? Because the minimum expectation was 19, given that the beta was 2. So if the minimum expectation was 19, Alex, and the fund only generated 12, my alpha is not 0, my alpha is -7. Case 3, let's say the fund, the index generated 12, but my fund only took 0.5 risk, which means the minimum expectation, like I explained to you in the last question, was 8.5. But now if my fund generates 12, you might think that my fund has generated same as the index, right? But because my fund only took half the risk of the index, my minimum expectation was 8.5. So my minimum expectation was 8.5, but the fund generated 12. So I've actually done an alpha of 3.5. That's how you look at alpha in context of the risk that you took, not just simply comparing it with the benchmark returns, Alex.
Got it. And therefore, I think a question that I had at the start of the conversation is clarified in that since you're looking at expectations, since you're mapping based on beta, you're looking at 1 year forward, right, usually, or do you extrapolate it beyond that?
So typically in the mutual fund space, Alex, beta and alpha, they're typically looked at from a 3-year time frame. So because I'm talking to retail investors who are going to watch this show, most of these websites which give you free data on the internet, right, like a value research or an advisor coach, so on and so forth, all of these guys would show you alpha for 3 years. So while you're not a professional from the industry where you have access to a lot of data points, typically most of these websites which will show you this data point of alpha, they would all look at a 3-year data point, Alex, and not a 1 year.
Okay, fair enough. My next question relates to how you should utilize this. So you have alpha, and you've understood alpha. It's not active returns, it's alpha. You can't look at this in isolation, right? You need to have various parameters that get added into this, because I would think that the actual playing out and whether this active return maps out to what the alpha is would be subject to a lot of other factors coming into play, right? So how does one take this in the context of choosing funds?
So, Alex, look, there are two ways. Let me put this across. If you are a retail investor, and I would like to believe that as a retail investor, you would not have access to a lot of information, data points, and even if you have that, being able to interpret what that means is going to be slightly difficult always. So let's say if you're a retail investor, right, instead of just looking at return that the fund has been able to generate versus the benchmark, and trying to say that, every time the fund generates higher return than the index, that fund looks good to me, look at alpha as a more better proposition in selecting fund. So if you're a retail investor who so far was only looking at the return that the fund generated for selecting the fund, I think alpha is a much better data point to look at. So look at alpha, you will largely be able to understand for the risk that the fund took, how much return has the fund generated, and you will be in a much better position to determine versus what you were doing initially, saying that if the alpha is positive of the fund largely has been able to generate better returns for the risk that it took. But if you're a professional in the industry, Alex, there are multiple other data points that you should, in my opinion, really look at. So you look at alpha, you look at the rolling return performance of the scheme over a period of time. You look at something called as Sortino ratio, which helps you understand for the downside performance of the scheme or index, how has the scheme performed. You look at something called as an up capture, down capture ratio to try and understand that every time that the market went up or down, how did this fund perform? So if you're a professional, you look at multiple data points for you to be able to figure out whether this scheme looks good in terms of performance. But if you're a retail investor and so far you are only looking at returns, I think alpha is a much better jump for you in terms of analysis. Look at alpha and you will have a slightly better perspective of a fund versus the risk that it took, Alex.
I get it. In that, it's another filter that you can put, whereas people traditionally would have looked at rolling returns or would have looked at the active returns to say how much is a fund beating the benchmark by. They can also compare with other funds on the basis of alpha once they have done that initial filter. Okay, I take your point. Very quick view, Kirtan, on large caps, and I think we've contextualized it based on our conversation so far, in that now perhaps we can talk about why very quickly, if it's possible, large cap funds have not been able to generate a significant amount of alpha. And in that sense, you would ideally choose an index fund because it makes sense for you to choose an index fund in the large cap space.
So Alex, three things have panned out in the large cap space very particularly. Over the last 2-3 years, you saw SEBI came out and move the way returns were calculated on the index to an TRI, total return index. So all the dividend income that the fund was making, which was not originally shown in index calculation, that took away a larger part of the returns specifically that the large cap fund was showing. Also, over the last 3 years, where categorization came in 2018, now large cap funds have to invest 80% of the money only in the top 100 stocks. That took away a lot of liberty which the funds had before 2018 and categorization came in. And third, very importantly, Alex, you would see if you go back a little before pandemic, majorly our market was very polarized. So there was a time where Reliance moved from 900 to 2700, a 300% move, right? Where the index swiftly moved up because of the weight that Reliance had. But mutual funds to a larger extent could take on a higher side only 10% position in Reliance, right? So whenever the market is polarized, mutual funds hands are tied because they can't take more exposure than 10% in one of their stocks. I think these three things have really played out over the last 3 years, why large caps have not really been able to generate alpha.
Yeah, perfect. I also asked you to give us an idea in a couple of categories, and I know that we can discuss a lot of categories, but I asked mid caps and flexi cap funds for you to choose a couple of options from each that stand out in terms of alpha generation. Could you tell us what those are?
So, Alex, this will also very, very well, help viewers understand exactly what I was trying to explain at the start of the conversation. So let's say in the mid-cap space, if you look at Axis Mid-Cap or a Kotak Emerging Equity Fund, right? Let's look at example of Axis Mid-Cap. Now the index generated over the last 3 years some 24.58% CAGR. The fund has generated 28.11. Now when you deduct this, you will get active return as 3.53. But if you do an alpha calculation, you will understand that the alpha of the fund is 7.58 because it is not the return that the fund generated minus index. It takes into consideration risk, right? And hence this will showcase to you how active returns are so different from alpha. So in the mid-cap space, I think two funds which have generated alpha on a very regular basis, in my opinion, is Axis and Kotak, right? While you look at flexi cap, I like the Parag Parikh flexi cap and this SBI focused equity. I think PPFAS has been able to generate a 12.83% alpha over the last 3 years, and SBI has been able to do 8.42. I seem to like these four funds while we talk the mid cap and the flexi cap category, Alex.
Absolutely. You know, this has been a very insightful conversation, right up to the illustration of the points that you were making with the funds that you've identified. Thank you so much, Kirtan, for taking the time.